Hey, this is Melissa Harmel with eXp Realty, and welcome to our 13th Home in Alaska show. I am super excited today to be talking with one of the top loan officers here in the Alaska area, Rhonda Johnson. And so, hey, Rhonda, how are you today?
Hey, Melissa, doing great.
So, Rhonda, can you tell our viewers how long you've actually been doing mortgages in Alaska?
Yeah, Melissa, so I've been doing this since 1983. So, we're in a unique little cycle right now, but it's not the first time. And this cycle will turn around and look differently at some point in the future as well. And I know you've seen quite a few of these cycles as well.
Yes, I got my license in 1998. So yes, I was here when we went through that, what we call the housing bubble. And so
Right.
yes, much different today
Yeah,
than what
yeah,
it was in the
absolutely.
housing bubble, much different. But some things still remain the same. And I know over the 15 plus years that you and I've worked together, your ability to educate and help people understand what does it what needs to happen in order for me to get a home loan.
Yes.
So thank you for telling me that we should be doing a 5-part series on credit scores, because
Mhm.
credit scores are really a huge factor when it comes to getting a home loan, correct?
Absolutely. And by the time we get done with this, you'll have a really clear understanding of just how much that can affect your buying power, especially in this increasing rate environment that we're in. So, this is hugely important to get a really good handle on the credit score, find out where you're at, find out what we might be able to do to help make it better to give you the best shot at qualifying and getting the best interest rates.
Well, and I know that in the past, even with my clients who have had 700 plus credit scores, you're like, hey, if you did these 3 things, we could get that credit score up here, which then means you get the interest rate and the fees down here. So why don't you
Exactly.
do that over the next 30, 45 days and let's get you that lower? Which
Exactly.
when interest rates are rising, I think that is super important.
Absolutely. Absolutely. Because again, saving on that interest rate can give you another 10, 20, $30,000 worth of buying power, depending on how much we can save you on that interest rate. So I think that the education, there's a lot of misinformation out there. There's a lot of myths out there about credit scoring. So I just kind of like to go through it and break it down into bite-sized chunks for you and talk a little bit about what goes into that credit score. What should you be looking for? What affects the score? And how what you have control over and what you don't have control over.
So we're going to call this show part 1, credit score introduction. And so again, if you've ever had the pleasure to sit down with Rhonda and have her walk you through this, bam, eyes are opened. You will learn so much. So this is part 1 of our 5-part series. So Rhonda, what is a credit score?
So this is really kind of fascinating to me, Melissa. Did you know that the credit score, it's a 3-digit number that's assigned to you that's based on the habits of about 5,000 people from the 1960s? So have a few things changed since the 1960s? Of course they have, but the basic scoring model hasn't changed since they did this original sample of creditors way back in the 1960s. So the scores range anywhere from 350 to 850. And sometimes I'll hear clients saying, oh, well, I have a 900 score. And they very well may see a 900 score because there's 2 different scoring models. So there's the FICO model that most lenders use, and then there's the Vantage score that sometimes the consumers will see. So the Vantage score is on a 450 to 950 scale versus the 350 to 850. So if you're looking at your own credit report, you want to make sure you know which model they're using because it could have a huge effect and a big difference on what a lender is going to see for you.
That makes sense.
Yeah, and there's 3 major credit bureaus, TransUnion, Equifax, and Experian. And everybody will ask, well, why do I have three different scores? What is the difference? Well, each one of those three bureaus uses a different scoring system. So if you have a late payment, then one scoring system might give you a 20-point hit, one might be a 22-point hit, one might be an 18-point hit. Or if you have an inquiry and that kind of thing. So they have a little different scale that they use depending on the different events that happen on your credit report. And the other thing is that not all creditors report to all three credit bureaus. So it's super important that when you're checking your own credit report, you are checking all three bureaus, or you could be missing something. So, JCPenney's might only report to two and not the third one, because it costs those creditors money to make those reports to the credit bureaus. That's how the credit bureaus make money, is they charge the creditors to compile those reports. So not all creditors want to spend the money to report to all three.
Makes sense.
So there's 5 factors that affect the score. The first one is, of course, your payment history. How well do you pay your bills? So this is the biggest indicator of how you're going to probably pay your new credit that you get when you buy a home. The next one is the credit level. So how much do you owe compared to your balances? And then the length of time that you have your credit, people checking into your credit, and then the mix of credit is super important as well. So today, I'd just like to talk about one of these with you, Melissa. Let's go into the payment history, because there's a lot of questions about what happens if. So one of the things to keep in mind is that the payment history is the largest piece of your credit score, but it's only 35%. So there's 65% of other things going on in your credit report that a lot of people don't pay attention to. So I have clients tell me all the time, I have a perfect payment history. I've never made a late payment in my life, but they don't have an 850 credit score. So we'll be talking about those other factors later on. And one of the things to keep in mind is that anything that happens in your credit report, as far as your payment history, that happens in the most recent 12 months is going to hit your score the hardest, good and bad. If it's 12 to 24 months old, it'll still hit it, but not quite as much. Once it's 24 months old, it kind of starts fading out of your credit history, or out of your credit score, let's say. It'll remain on your report for a while, but out of the scoring factors after 24 months, it starts fading out. So you could have a perfect payment history and make just one 30-day late payment, and it can drop your score by 50 points. Now,
Wow.
late payments is really important to designate too, because what they consider a late payment is if you're more than 30 days late. So if you happen to pay it 15 days late and you have a late fee that you have to pay, does not necessarily mean it's going to report on your credit report as a late payment. But 50 points for just one late payment. You could have a perfect payment history and make one late payment, and boom, that's going to have a big effect on your score. Another myth that happens a lot is people will say, oh, I have some old outstanding collection accounts. I'll go pay those off and my credit score will instantly get better. But here's the thing. Remember that 24-month rule that we talked about. If you pay off a collection account that's more than 24 months old, then what you've done is taken an old unpaid derogatory piece of credit and paid it and make it brand new on your credit report again as a paid derogatory piece of credit. And so if our loan approval is subject to them paying off some collection accounts, I always ask that they not have to be paid until right at closing, because I do not want to risk the chance of affecting their credit score and therefore perhaps affecting their interest rate.
And I have seen this happen. I have seen buyer's agents call me on my listings when we're under contract and say, oh my goodness,
Yeah.
the loan officer just pulled credit right before closing, and these guys went in and paid these collections, which we're all saying good for paying them, but you should have listened to your loan officers. So I'm not sure if all loan originators, loan officers share this information, because I have seen it delay closing by 30, 45 days why we had to fix some things.
Yep. Yep. And I can almost guarantee you that not all clients get this information from their loan originators. So that's why your message reaching out to numerous people is really important to me to help give this education. One more thing with collection accounts is that if they're medical, they do not actually hit your credit score as long as they're designated as medical. Medical is kind of a little set aside collection account, because if you charged up your Visa card and just chose not to pay it off, you kind of did that of your own free will. And with a medical collection account, usually it's because something big happened in your life and it was a major bill that was an unexpected expense. That, I mean, some of those things, gosh, I had some surgery a while back and I ended up with 6 bills from people I never even knew looked at my body. So those are things that can easily get slipped by and that are not willful disregard for your credit. So keep that in mind too. Medical collection accounts, we're going to have a totally different discussion on. If you're currently past due on any account, could be another 50 points. I like to clarify that the divorce decree, if you have the unfortunate event to go through a divorce, the divorce decree does not take precedence over your credit agreement. So if husband and wife go in and buy a car together and they're on that note together, they end up getting a divorce. The judge says, you get this car in debt, you get that car in debt. Just because the judge says so does not mean that you're relieved of that obligation to your bank or your creditor. So I've seen that hundreds of times where they said, well, the judge said, but the judge didn't go in and sign that note saying, I promise to pay. Husband and wife signed that note saying, I promise to pay, not only if we don't get divorced. So you're still under obligation. If you go through an event like that, my suggestion is that, yes, you get this car, you get that car, but make them get refinanced into loans in their own names and not be continually tied to that obligation.
And again, I've seen this one, really, this misinformation. I actually met with a couple yesterday who's separating, and I told them both in very strong terms, make sure you're equally making the mortgage payment as you have been. Do not, because it will affect both your credit, because you're both on the mortgage and you're both on the deed of the house. So you both need to be making the mortgage payment until this one is resolved. Yes.
Yep.
And they looked at me and said, wow, no one told us that. I said, well,
Yeah. No, see, that's great. So I love it.
Well, I learned from you.
Well, and I love partnering with people that can help, back up that good advice. So a couple other things, we'll save that next piece for our next
next week's class.
For next week's class, yeah. So so another thing that's important too is that the reason why we say that a 30-day late payment could be up to 50 points is that there really is a hierarchy of late payments. So for example, if you're late on your mortgage payment, that's going to have much heavier weight on your score than if you miss a $10 credit card payment. If you're late on a car payment, some of those car payments are as much as mortgage payments these days. So car payments have heavier weight on the score as well. So any of those events. So when we get done, then I'll tell you how to get your own free credit reports, how you can get your scores, and some of the secrets to be looking for when you're reviewing your own credit report. But payment history is the first factor, 35% of your score, big, heavy piece of the credit score, but not all.
Perfect. So you guys remember who are watching that this is a 5-part series, and this is part 1, just credit score introduction. So make sure you stay tuned for our next 4 shows that'll be coming up over the next few weeks. And again, Rhonda, thank you very much for joining us today and sharing all this information.
Yeah, my pleasure.
Wherever you guys are viewing this, Instagram, Facebook, YouTube, all those places, make sure you jump back on YouTube and subscribe to our channel. If you have questions or comments, you can always put those in the comment section in YouTube, and we will respond to those. At the end of this video, you will see the contact information for both Rhonda and I. We actually do answer our phones. We actually do respond to emails. We actually do what we say we're doing here. So please feel free to reach out. We're always here to help and answer questions. And again, if you have topics that you would like us to discuss or you want more information about, please reach out to us and let us know, and we'll add those to the shows for the year. And so, Rhonda, we'll see you next week.
Hi, Melissa.
And remember to follow us on Facebook, Marketplace, Facebook, Instagram, or YouTube.